This current macro environment, demand for defensive allocations and income is rising. So where is the opportunity? Alan Greenstein is the Chief Executive of Zagga. He joins us again now. Alan, welcome back.
Thank you, Andrew.
So we know what's going on globally at the moment. Risk assets being sold off heavily. Where do you hide at the moment?
It's a good question. I think that you've got to hide in cash or near cash. That's generally what investors do during these times. And we can see markets coming off. We can see gold volatile, other kinds of commodities and currencies volatile. So I think most investors are looking to take as little risk as possible. And for them, they're looking for something which was going to give them predictable, transparent, consistent income. And that sounds like fixed income or cash or near cash kind of product. And to the extent that private equity, private credit sits within that, property private credit specifically, I'd say that that would be one of the boxes to tick for those investors who are looking for a safe haven in times like this.
All right, get to that in a moment. Defensive allocations. I mean, traditionally you would move to bonds, but I mean they have been sold off remarkably, haven't they? And you look at like the Australian 10-year yield is at 5.2%.
Correct. In fact, I was speaking to somebody this morning who said to me that the last time he saw that was in the 70s. So that is interesting in and of itself. I think the problem that you have with bonds, if you do the analysis, the volatility analysis, is bonds, although they look that they're counter-cyclical and that they're not volatile, they actually are quite volatile. And that's the problem. And we used to be able to invest in hybrids, which were also pretty close, but hybrids are no longer available in the market. Fixed income in the form of, say, cash deposits are good as long as interest rates continue to rise, but those yields are quite low. So you've got to find the next best alternative. And speaking to my own book, I'd say to you that would be in defensive real estate private credit assets where the yields are predictable, the yields are consistent, the yields are reliable.
All right, what happens there, particularly in a potentially stagflationary environment? We are seeing, obviously, inflation rise rapidly, interest rates going in the same direction as a result, and overall, though, that's likely to stymie growth.
I think that it's very important not to maybe lump Australia into the generic bucket of what happens in those times. The saving grace for us, I think, is the fact that we're funding into a tremendous housing shortage. I read in the press this morning that we're taking in 920 new immigrants a day into Australia. We have net immigration of 600,000. We have a shortage of about 1 million houses. I think that despite the stagflation, despite all of those things, we still have to house the population. So I'm not suggesting to you that things are not going to be more expensive, that affordability is going to be an issue, but we have to keep building into that, and that is going to continue to drive demand, and it's going to continue to drive return.
All right, but you're saying that private credit, all is not created equal, and I guess, goodness, you only have to look at what's going on in the US at the moment with the so-called cockroaches coming out of the woodwork, aren't they, pretty quickly at the moment? In fact, many predicting that's going to be turned into a serious financial crisis if we're not already there. But Australia is different, you think?
I think it's different for a few reasons. Number one, a large part of the US market is corporate private credit. We don't have nearly the exposure in Australia to that you have in the US or even in Europe.
Well, and they're particularly leveraged to the AI thematic.
Correct. Very leveraged to AI, very leveraged to balance sheet financing across all kinds of industries which are now going to be impacted by AI. And I think that is what you're seeing there. Secondly, they have a very, very well developed secondary and tertiary market for those products, which we don't see at all here. Our market is largely private credit oriented. And thirdly, just in terms of the scale of both markets, I mean, a lot of private credit is not accessible to retail investors, whereas in the US it's completely different. So yes, I see what's happening over there. It's not to say that if the US catches cold that we won't get some sneezing over here, but I think that the markets are differentiable.
All right, you're saying it's not overly accessible for retail investors here, so how do they get access?
Well, I think most retail investors here have gotten access to one of the LICs or LITs that are on the ASX. Those are clearly subject to all kinds of scrutiny and all kinds of checks and balances. There are those funds which are retail oriented, but I would suggest to you that most of the investors in property private credit at the big end are the larger financial institutions, the super funds, the large banks, the larger family offices, and they take a different view of the market. It's not to say that retail investors won't be impacted, But we've heard the regulator say that he doesn't want retail investors in property private credit and in private credit generally for these very reasons. So yes, there may be some exiting or withdrawals around that, and we may see certain funds, have to deal with redemptions. We didn't see, we saw some redemptions during COVID. GFC property private credit was not as well developed as it was now. So there are areas for retail investors to get into the market. But like I always say, whenever I speak to you and I speak to anybody else, every investor needs to be sure that property private credit is an asset class that suits their specific investment requirements.
And you speak to that demand. You've already mentioned, obviously, hybrids disappearing. We've also got the growth of SMSFs. And also, Div 296, the changes to super tax there, is that once again sort of these investors looking for greater opportunity and perhaps private credit is where they're looking?
Yeah, so Div 296 is this gift that keeps on giving and getting taken away. We're not quite sure what's going to happen with it, but there's no doubt that I think we're beginning to understand that there are going to be changes to tax legislation. That is a reason for people to want to move away from capital heavy assets where their capital gains tax may be impaired. So some of the exemption may be taken away. There are large CGT type taxes. Property private credit being a debt instrument, being an interest payment, you're paying tax on the interest that you earn. So far, if it's in your self-managed super fund, you're going to get the benefit of the lower taxes on that. So I think it is an asset class that investors are looking in for, not only asset protection, but also for income.